You're listening to Simply Put, a podcast from FHN Financial. I'm Sophia Kearney-Letterman, Senior Economist with FHN Financial, filling in for Will this week. The Community Reinvestment Act, or CRA, was passed by Congress nearly 50 years ago in an effort to promote lending within banks' local communities. As the country and financial system change, regulators continue to find ways to modernize the CRA to better fit the times. With the newest set of proposed changes, banks are starting to consider what compliance would look like, and regulators are evaluating whether the changes will successfully address current issues. On today's episode, we talk with Brian Waters, President, COO, and co-founder of FindCRA, about the history of the Community Reinvestment Act, how effective it is in fulfilling its goals, and the potential impacts proposed regulatory changes will have on the financial system. Stay tuned. Coming up soon, Will interviews Brian Waters, President, COO, and co-founder of FindCRA. But first, a quick market update. The April PCE report out this morning showed that personal spending rose 0.2%, less than expected to start out the second quarter. Inflation-adjusted real personal spending fell 0.1% in April. The core PCE deflator, which is the Fed's preferred inflation metric, rose 0.2% on the month, the smallest gain this year. The annual core PCE inflation rate held steady at 2.8%. After 3 months of discouraging inflation data to begin this year, the Fed will need to see a handful of consistently good inflation reports before being comfortable cutting rates. The first revision to Q1 real GDP this week showed growth was revised down from the initial 1.6% annualized to 1.3% this week, as upward revisions to business and residential investment were offset by a downward revision to consumption from 2.5% to 2.0%. The quarterly annualized core PCE inflation rate was revised from an initial estimate of 3.7% to 3.6%. Last week, Treasury yields were largely steady outside of upside surprises from the S&P PMIs. This week, Treasury yields rose before falling immediately following the April PCE report, with the U.S. 10-year down 4 basis points to 4.50%. The employment report next week should set a new anchor for economic and rate expectations. The minutes from the Fed's May 1st meeting were released last week, consistent with the comments we've heard from Fed officials in the last few weeks. The FOMC will need to see more inflation improvement before considering policy easing, and the economy is in a generally good place with little risk of a downturn right now. The minutes noted that a few participants brought up the possibility of future rate hikes, but that scenario is still considered very unlikely for now. Fed funds futures are suggesting expectations for 1 or 2 25 basis point cuts by the end of this year, with the first cut fully priced in at the December Fed meeting. That's all for the market update this time. Now, our interview with Brian Waters.
Our guest today is Brian Waters, President, COO, and co-founder of FindCRA. Brian, thanks for coming on the podcast.
Thanks for having me, Will.
Our topic today is the Community Reinvestment Act, the history and motivations behind it, how it impacts banks, and some potential changes on the horizon. Brian, walk us through the basics of the Community Reinvestment Act, or CRA. When did it get passed, and what does the law exactly say?
The Community Reinvestment Act has been around since 1977. It's one of the last of a series of regulations that were passed in the 70s to address discriminatory practices and redlining that was observed through decades of government policy. So it started with the Equal Credit Opportunity Act and the Fair Housing Act. Then we had the Home Mortgage Disclosure Act. And then in the late 70s, Carter signed into law the Community Reinvestment Act. When it was enacted, it was solely focused on preventing redlining in communities that had had historical disinvestment through government policies. But as CRA has evolved over the last 4.5 decades, in 1995, there was a pretty major rewrite put into place that expanded the framework for the Community Reinvestment Act, or CRA. And within that framework, there was a new regulatory public evaluation process put into place that also stratified banks into multiple asset size designations and then imposed new requirements on banks to also track and report their retail services, their community service done by bank employees and by directors, and then also their investment process. So that can be large scale investments that they participate in for community development, or smaller scale investments that they provide through their donations and grants into mostly nonprofits, but other community partners. And with that new framework that came into place in 1995, that has been the overriding process under which banks have operated since then to ensure that they are providing credit and providing bank services to all of the communities where they have a main office, where they have a branch, or where they operate a deposit-taking facility.
I think that's all really helpful, and I want to go back actually to something. I know you mentioned redlining, so I can see that historically, just about 50 years ago, this was a kind of final piece of the puzzle to make sure that access to credit was there for people who were historically disenfranchised from the financial system. Now, when it comes to housing affordability, is CRA something that typically plays a role? Because, of course, the access to home ownership is such an important part in kind of American society to have generational wealth. Is CRA playing a role there, or is housing affordability really just at the whims of other agencies or other factors in the housing market?
Yeah, housing affordability is one of the four pillars of the current CRA framework. So there are four main areas under which a bank can receive community development credit and when it comes time for the evaluation of the bank's activities during their periodic CRA examination. So those include revitalization and stabilization of neighborhoods. It also includes community services, supportive services to low and moderate income individuals. It includes economic development, primarily focused on small businesses and small farms. And then the fourth pillar is affordable housing. And unlike the other regulations, like equal credit opportunity and fair housing, that are focused on protecting certain classes of individuals based on their race or ethnicity, age, gender, CRA is an income-focused regulation. So it's focused on providing bank lending and opportunities for what are defined within the regulation as low and moderate income individuals. And that is a much higher threshold than you would anticipate. A moderate income individual can have as much as 80% of the average income, or what is technically called the area median income, for the community where they live. So that can be a significant amount. And because CRA is an income-based regulation, and because, as we've seen acutely now throughout the history of the regulation, affordable housing has been a core concept that is supported by the regulation. And as housing has become more and more unaffordable in the modern era, CRA has a great opportunity to support activities that provide affordable housing, both for single-family homeowners, but also through larger structured multifamily properties as well. And it is a core concept supported throughout the regulation, even into the new modernization efforts in CRA.
Those different pillars that you mentioned are all really helpful to kind of put more color to the kind of mission of CRA. Now, I'm kind of curious, though, whether some of the law is too vague to be really effective, and I think we'll get later in the conversation into some of some kind of upcoming proposals and different ways to modernize the law. But I want to talk a little bit more about enforcement. So you described the categories that go into this, the criteria that banks need to meet under the CRA. Do these boil down to objective numbers, a sort of percentage? How do regulators enforce the CRA for a lot of the criteria you mentioned? Like, what does it mean to say that banks are providing enough capital to its local community?
Right. So with CRA, it's one of the few regulations that remained with what are sometimes called the functional bank regulators. So within the regulatory framework after Dodd-Frank, in response to the 2008 housing crisis, many of the regulations moved into the new Consumer Financial Protection Bureau. But with CRA, which is an act, it is still enforced through interpretive regulations that have been issued by either the FDIC, the Federal Reserve Board, or the OCC, the Office of the Comptroller of the Currency. And each bank, when they file for their bank charter, they are assigned one of those three agencies as their functional regulator for many aspects of banking, but also for CRA. So within CRA, it is the only bank examination process where the bank results are evaluated and a public evaluation report is issued. So for any bank in the nation, both historically and current banks, you are able to go out to those regulators' website and see a copy of that CRA public evaluation that evaluates the bank's track record and provides feedback on how they're performing and meeting community needs. And each bank is assigned one of four ratings that range from outstanding to satisfactory and down to needs to improve and non-compliant. So within those frameworks, the majority of banks within the United States are assigned one of three asset sizes, either small, intermediate, small, or large banks based on their average assets. And when the examiners come in to do that evaluation periodically, banks are evaluated first on their lending track record. Every bank is evaluated based on their major product lines to determine, are they providing enough home mortgage loans or small business or small farm loans to the communities that are of interest to CRA. So those low and moderate income individuals, those businesses and farms making less than $1 million in gross annual revenues generally. And the banks receive a rating based on their own lending activity in comparison both to demographic benchmarks sent by census data, as well as aggregate benchmarks for other lenders within their community. And that rolls up to their lending rating. And then those intermediate and large banks are also assessed on their community development activities, their investments, and their services. And each of those receive their own rating as well. And all of those ratings combined to roll up to an institution level rating for the bank.
How much teeth then do those regulators have? So let's say I'm a bank and I perform quite poorly on these metrics. I get a bad rating. Do I get a fine? Do I get a probation period where there's a threat that my charter will be revoked? What is the enforcement mechanism like in order to ensure that banks kind of live up to these standards?
So if a bank is assessed at the institution level and needs to improve or substantial non-compliance rating, there is a significant constraint on the bank's ability to grow. They can't merge, they can't acquire, they can't even open a new branch until they are re-examined and show that they have increased their performance in whatever areas they are underperforming. Also, from a reputation risk, since that is a public rating, there is a lot of interest from watchdogs groups, from other industry players to monitor banks that fall into that needs to improve rating or below to ensure that they are taking the steps to improve that underperformance. Banks also have a requirement if they fall into that level that they then have to begin ongoing and quarterly reporting to their regulator, which is also placed into their CRA public file to show how they're addressing those areas of underperformance. So it can be a very costly, both from a lost opportunity cost, but also a hard cost endeavor to ensure that you're remedying any areas of underperformance if you do have those negative CRA ratings.
There are some proposals that have put CRA back in the news recently. Can you tell us about these latest proposals and what inspired them?
Yeah, so CRA, as I said at the start of the podcast, back in 1995 was our last major rewrite to CRA, and there have been some technical amendments, and the agencies do have the ability to issue interpretive guidance as needed. So there's a pretty robust series of questions and answers. There was a timely guidance issued related to CRA and the pandemic response, but there hasn't been any major rewrite to the implementing regulation since that 1995 major restructuring of the regulation. And with the way that both banks have evolved, with the increased level of mergers and acquisitions, but mostly with the shift to more non-bank competition, fintech lenders, the lack of dependency on a branch network, there was a challenge put out to rethink CRA that started with a Treasury memo back in 2018 to look at the market placement that banks are evaluated under within CRA. That's a technical term called assessment areas. So where they have those main offices and branches, but also to look at the entire examination structure to say, is it capturing evaluation in the correct format? Is it also considering and providing enough objectivity and transparency and timeliness within the examination framework? So that led to a long roller coaster of regulatory activity since 2018. There was a push shortly thereafter from all three banking agencies to issue a new CRA modernization rule. But when the pandemic hit, we saw kind of a splintering of that effort. The OCC moved forward with their own final rule that was in effect for about 15 months. The Federal Reserve proposed a rule but never finalized it. And the FDIC said they were focused on the impacts from the pandemic, so they stepped back from the modernization efforts. But once we recovered from that pandemic, starting again in 2021 and going into the current day, the regulators moved forward and came back together and issued an interagency proposal to modernize CRA. And that proposal came out in 2022. There was a comment period for 60 days. And then finally, in October of 2023, we saw the text of that final rule issued. It was over 1,500 pages, and then it didn't appear in the Federal Register until February 1st of this year, and that clocked in at over 2,000 pages. And that new regulation is really taking to heart a lot of the recommendations and the changes within the banking industry to modernize kind of how we look at community development, to address expansion of assessment areas. And it's a very significant overhaul of that evaluation framework under which bank performance will be reviewed by their examiners.
The CRA was passed during a much different time for the economy and financial system, the late 1970s. And so I'm curious, is today's banking system too complex for these rules to address the original concerns from 50 years ago? I'm thinking of online banking, shadow banking, big international capital flows, just to name a few. What is a bank's community this day and age? And does it make the system so complex that even modernizing CRA could be prohibitively difficult in order to achieve its goals?
Yeah, and I think it's important, again, to draw that distinction between the regulation and the act. So all of the modernization efforts we're talking about are within the banking industry, with banks that have filed for bank charters, that have FDIC insurance, and that are regulated by one of these three banking agencies. And the reform that's currently happening is only addressing the regulation that implements the act. It is not a change to the act itself. So what we have seen in recent years, to your point, is this evolution in how consumers and businesses access banking services. And while the regulators can rewrite the regulations for the 4,600 approximately banks that they have regulatory authority over, they don't have the ability to change the act. That would take a congressional action. So the call to pull in non-bank entities, fintech companies, mortgage lenders, credit unions, and make the Community Reinvestment Act applicable to them exceeds the statutory authority of these three bank agencies. And as we've seen now, there are more credit unions in the United States than there are financial institutions. And fintech companies, many of those operate without a bank charter, but they're processing transactions and they hold assets at a level of some of the largest banks in the United States. So in order for CRA to truly evolve to address the current financial landscape in the United States, the act itself would have to be modified more than just the implementing regulation.
Within that framework, let's say we assume that there is not a legislative change from Congress. Do you think these rules that you just described will be effective at addressing the problems they aim to solve? Or do you think there are superior alternatives available that are not being considered right now?
I think they get us partially there. I think that the evolution that we see in the framework within the community development definitional changes seem progressive. They pull in more opportunity for banks to get credit. They give banks more credit for activities they're already participating in. And the concept that is being evaluated or proposed in this final rule of expanding outside of facility-based assessment areas, which we operate under today, and establishing additional footprints to try to capture some of the activities that banks participate in outside where they have physical locations is conceptually the right concept. Now, in effect, and there has been some challenges to the framework that has been proposed, the approach of taking a look at bank lending activity and for certain banks requiring banks to establish retail lending assessment areas, or also lumping together all of their non-assessment area activity into a single test. There has been some challenges as to whether that framework is going to be successful in actually evaluating bank lending across the board and really helping bankers to adhere to equitable access to loan products to the target communities that are dictated within CRA.
I can see how CRA really addresses where banks are deciding to issue their loans, kind of the recipients of bank lending. But I'm curious then about securities that banks have on their balance sheets. Will any of these new rules that you've discussed, if they're passed in their current form, change the attractiveness of certain securities? Is there any way that CRA adherence now shifts the appeal of certain securities banks can have on their balance sheets?
Much like all the areas of the new final rule, that's kind of a double-edged sword, because there are some considerations given that will motivate banks to potentially change their investment strategy, in that in the framework, if a bank invests in a low-income housing tax credit, if they provide investments into a minority or women-owned financial institution, or into a U.S. Treasury certified community development financial institution, or CDFI, or a low-income credit union, those activities will automatically receive CRA credit going forward. Also, banks are incentivized to participate in some new forward-looking areas, also providing expanded support for activities in Native and tribal communities and in disaster and weather resilience preparedness programs. But with that expanded opportunity and that guaranteed credit, the way that banks will be evaluated in this new final rule commingles activity under community development lending and community development investment. So currently, for any bank that has over $1.5 billion in assets, they have a standalone investment test that they have to show through their investment, the prior period investments that they're continuing to carry on their books, but also new investments that they make during the current evaluation period. That is evaluated as its own test, which accounts for 25% of the overall rating for the bank. But within the new framework, all of the bank's community development lending and all of its community development investments will be commingled into a single new community development finance test. And while that test will account for 40% of the overall rating, banks, unlike today, will also get to receive credit for any community development loans they hold on their books. So my concern is that when banks start to receive credit for potentially millions of dollars in loans that they're already holding, will that disincentivize them from continuing to invest at the pace and level that they are today because of this new commingled credit opportunity?
How are banks perceiving these proposals? Do you think they'll be closer to a kind of manageable headache for banks, or are they insurmountable obstacles? Now, understandably, banks would look at any changes as a sign of unpredictability, and of course, they need to read through these rules. There's a lot of effort that goes into understanding changes in enforcement, but from what you can tell, is this something that will be digested smoothly by banks, or is it something that could really actually end up curb lending in the transition process, or maybe cause more of an obstacle to certain size banks over other ones?
I think for our largest banks, and under the new rule, a large bank is any bank with $2 billion in assets or higher. Even those intermediate banks, under the new rule, have over $600 million in assets. This is a significant change. It is shifting CRA from a more subjective rule where banks have the ability to identify activities and build a case for consideration. The burden of proof is on the bank. And in the lending test specifically, everything shifts to a metrics-based formula. But above and beyond that, the new framework proposes significant record keeping and reporting of bank activities, both on the lending side, but also the community development side, that are going to require specialization in modeling and mathematics that most CRA officers may not have currently. So there will have to be not only investments in technology, But there is going to be a knowledge gap that has to be closed, both in understanding the regulation, but kind of figuring out, do we need to recompose our CRA teams? Do we need to do additional hires? And remember that with this regulation, it's not just the bankers who have to adjust to the new regulatory frameworks. There's thousands of bank examiners that also have to be retrained and have to institute new examination procedures and methodologies in place to affect and produce those examination reports once this goes into effect as well. So it's not a manageable headache. This is going to be a pretty massive overhaul to the day-to-day operations of banks, both strategically and how they invest and how they lend and which entities they need to be working with, but also in the technical aspect of ensuring compliance with all of the new calculations and reporting that are going to be mandated for the banks of a large size.
Looking forward then, what is the timeline for potential implementation? Anything that banks should be keeping an eye on to prepare? Are they going to have a good amount of time to make this transition? How should banks think about the next year or so?
This is a question we get all the time here at FindCRA, and I'm sure most other CRA experts are dealing with this as well. The rule set forth a time frame when it was published on February the 1st, and that time frame outlined an effective date of April the 1st for portions of the rule, but the majority of the changes were to be effective January the 1st of 2026. And then all of that mandatory record keeping would start January of 2027. So we had a 2-year basically implementation window that we were reacting to, but within days of that final rule being published in the Federal Register, the American Bankers Association, the U.S. Chamber of Commerce, and several other trade associations filed a lawsuit against the rule. And since that lawsuit was filed in mid-March, the judge that was considering that case has issued an injunction against the implementation of the final rule. And that final rule, that challenge is basically focused on two key concepts in the final rule: the expansion of bank assessment areas into those new retail lending assessment areas where banks lend in communities that they don't have branches or offices in, and also looking at the new retail service and product test, which is a standalone test that would evaluate a bank's product mix, both digital and responsive products. And that challenge is currently sitting in the court. But with that injunction, the injunction delays the implementation date of the final rule a day for each day that the decision is outstanding. In recent conversations that we're hearing that it is likely that the decision is going to come back in favor of the banks, the bank trade associations. And if that is the case, if the court rules that either one of those components are not within the statutory authority of the banking agencies, that requires a rethinking of the final rule, because the framework that has been established in the final rule is dependent on both of those concepts. So if the court comes back and says one or both of those are not viable, the agencies are going to have to rethink that final rule, which may lead to them pulling the rule back and having to repropose it. And then we're kind of back to square one in some ways, because it'll have to go back through a public comment period and the clock gets reset.
Brian Waters, thank you for coming on the podcast.
Thank you for having me.
That was Brian Waters, President, COO, and co-founder of FindCRA. The main thing I take away from that interview with Brian is how difficult it can be to modernize enforcement of the CRA while not becoming prohibitively disruptive to bank lending. Adjusting implementation to better suit the nature of today's financial system makes a lot of sense, but doing it in a way that does not overwhelm banks will be essential to fulfilling its mission. We'll see a handful of important events over the next couple of weeks that will set new anchors for economic and rate expectations through the rest of this year. On the data front next week, look for the April JOLTS, May ISMs, and the May employment report. After payrolls grew less than expected in April, investors will be looking for signs of labor market weakening in the coming months. The consensus expectation is for both job growth and the unemployment rate to remain steady from April. The following week features both the ever-important May CPI and the June FOMC meeting on the same day, Wednesday, June 12th. The April CPI wasn't as hot as the inflation data we saw in the first quarter, but the Fed will need to see much cooler prints in the months ahead before starting to consider cutting interest rates. The FOMC is widely expected to leave the Fed funds rate unchanged at the upcoming June meeting, so all eyes are going to be on Chair Powell's press conference and the updated summary of economic projections. We expect the dot plot will signal less enthusiasm for rate cuts this year within the FOMC. The big question is whether the median 2024 dot shifts from the 3 cuts expected in the March dot plot down to 2 or just 1 cut this year. The May PPI will be released the following day on June 13th, and the preliminary University of Michigan Consumer Sentiment Survey for June will come out on Friday, June 14th. After a collapse in sentiment last month that included an increase in consumer inflation expectations, markets will be looking out to see whether the April survey was a one-off. Also, starting June 1st, the Fed will begin enacting the changes to its balance sheet announced at the May FOMC meeting. Chair Powell has been emphatic in pointing out that the tapered pace of security roll-off will still lead to the same balance sheet size in the end, allowing the Fed to slow walk its way to figuring out where that level is in order to avoid any abrupt liquidity crunch in the financial system. That's all for today. Thanks again for listening. I'm Sophia Kearney-Letterman, Senior Economist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments.
This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.